Good afternoon, everybody, and welcome. We just had some last-minute IT issues, and I think just given the reality of life today with COVID and everybody being moved online, despite all the dry running that we do, we then find other issues cropping up. So I hope you'll bear with us if those issues persist. But we're confident that we should have a fairly smooth investment conference. So on behalf of the team at GM Investments, we'd like to welcome you all to our annual investment conference. As I said, just like pretty much everything else this year, our investment conference has been moved online as well. So we haven't been able to avoid the impact of COVID in terms of our annual investment conference. We had a long debate about whether or not we should go ahead with the conference. I think just given the fact that we still find ourselves very much in the middle of this crisis. And I think most people are starting to understand the crisis or starting to understand COVID and what it means, apart from Donald Trump maybe. But I think everybody else is pretty much kind of on board that we're dealing with something fairly serious. What I would like to do is just take you through the agenda very quickly. Again, the agenda is influenced to a large extent by COVID in the fact that, unlike many of our previous investment conferences, this one is a lot shorter. In the online environment, you do not want to have half-day and full-day events for free because you tend to lose half your audience after the first 2 hours. So unless people have signed up and paid and they're going to get CPD points, they generally do not hang around longer. To put a shortened version together, but also focus on the content to make sure that the content itself speaks to a lot of kind of the second round impacts of what is happening with COVID. So as I've said, COVID has pretty much put everybody online. People are working online from home. Conferences, meetings, all happening online, AGMs. And what we want to understand with our first presentation from Steve Watson, who's the investment marketing director at Investec, or now known as NinetyOne Asset Management. He's going to be speaking about the end of privacy, or the end of privacy. Privacy, tomato, I say privacy. So the end of privacy, and have we exchanged our privacy for convenience? And what are companies doing with our data? What should we be aware of at this point in time? So with everybody moving online, we're connected to our devices a lot more. What are some of the implications of that? We're also very excited to have Cy Jacobs. Cy is a co-founder of 361 Asset Management, who will take us through a local and global market overview and talk a bit about, just how they as an asset manager navigated through the COVID crisis as it played out in March and April, and how they're seeing the markets, local and global markets now, in the midst of this ongoing pandemic. What I would like to do after that is speak about the issue of how safe are our retirement funds. And this, we've had lots of questions from clients. Lots of you are very concerned about the talk in the market about changes to Regulation 28 and introduction of prescribed assets and what that means. And it's become a fairly emotive topic. And there's a lot of scaremongering out there that's also happening. So we want to address that issue, hopefully in a fairly unemotional manner and kind of facts-based, which is what we try to be, and rather look at this from kind of that perspective and not get into the whole emotion and politics behind it. And then Gradidge and I will take questions from you as the audience, as our clients. If you have any specific questions for us that you'd like us to address, Gradidge and I will then do that. After each presentation, the different managers will have some time for Q&A. Okay, so I just want to take us through the housekeeping. So even in the online environment, there are some rules and some housekeeping that I need to take you through. I think firstly, just to note that the webinar is being recorded, and we will share a link with you after the meeting or after the presentation. After the conference, you'll get a link to this conference. Everybody has been muted. However, what we've discovered subsequently is that people are able to unmute themselves and speak. So we'd like to request for everybody to ensure that they are muted so that we do not hear the dogs barking in the background or the wife fighting with you about not taking the garbage bin out, or whatever the case may be. If you could please stay unmuted so that we can hear from the speakers. And then if you do have any questions, there is a Q&A box. You can put your questions into that Q&A box, and we'll be able to kind of clump those questions together and get as many of those questions answered as possible. If you need the bathrooms are okay. Sorry, no, I have no idea where you are, even bathrooms there. But the fact that I can hear people laughing means that not everybody is muted. So if I can request that was a test. I see people are raising their hands, so we will not be taking any questions just yet. If you can post those questions, I'll then be able to look at them. I'm going to introduce the first speaker now. The first speaker on time is Steve Watson. I suppose the one question I have for you up front, Steve, was whether that picture was taken during COVID. Or
way before. I looked a lot happier then.
Indeed. So just a bit about Steve. Steve is investment marketing director at NinetyOne, and he's been there in his current role since 2014. He spent 13 years working as a client director, dealing with advisors, institutional investors, and asset consultants. Prior to joining the firm in 2001, Steve worked at Coronation Fund Managers for 5 years. He holds a Bachelor of Arts degree, a higher diploma in education, and an MBA. So it's a fairly unusual set of qualifications. Financial
Indeed.
services sector. So I'm expecting something that's a bit different to what we normally do.
Great.
Yeah. So Steve, over to you. Thank you very much for your time and for joining, and for tackling this very important topic of the
Lovely. Thank you very much. I'm just going to share my screen. Let me just get this. Unfortunately, the host has disabled participant screen sharing at the moment. So if our host can re-enable that, then I'll pop up my slides.
Steve, okay, more.
I think you just need to mark me as a panelist.
Co-host. Yes. Can you try now, Steve?
There we go. Right. Let's see how this looks. And does this look correct?
Indeed.
Indeed. Fantastic. Great news. Okay, super. So thank you very much for that very kind introduction, and thank you to everybody for joining us this afternoon. It's always a privilege to be with people at this time of day to start with, but indeed in your own homes. So we don't take that privilege lightly, and thank you very much to Gradidge-Mahura for the opportunity to address you today. It's always good for us to speak directly to those whose money we're actually investing. And today I'm not going to talk about markets at all. I'm going to talk about something that's very topical and that you've probably heard quite a lot about and seen indeed quite a lot about. In fact, there's been a recent documentary that's proved very popular on exactly this topic, and that's the end of privacy. And most of us, of course, are very aware that when we click on the accept terms and conditions, that we're accepting things that we don't always understand. But let me enlighten you just a little as to what actually is going on out there. Your personal privacy has been eroded in a number of very significant ways, and not least of which is there's been data stolen or lost. And just today, we've seen 2 major motor manufacturers here in South Africa come out with warnings that there is a scam underway right now whereby a email was sent to you saying that your car is needed for urgent repairs and that somebody will come around and pick it up, and you should just hand over both the keys and the spare keys and the service books and all will be well. And off your car goes, never to be seen again. Of course, these days, if you live... Yes?
Sorry, can you share full screen because we are seeing...
Sure, no problem. I wasn't sure whether it had actually gone to the full screen. How's that? Is that correct?
Thank you very much.
Fantastic. That's great. The thing is these days, if somebody is actually in the average suburb, you probably will see that car disappear down the road on a camera of some kind, probably one that in fact even recognizes number plates, because we've all given up our personal privacy in the form of surveillance in our own streets. In the street that I live, we have those exact same cameras which watch you come and go and which are monitored by artificial intelligence, as most of these things are these days, since people are just too expensive. And the monitoring of those cameras, of course, being done by machines is becoming a hot topic itself. There's data that others gave away on your behalf without you knowing. We very recently had the Experian experience, as it were, where a large credit scanner lost an enormous amount of data of banking clients in South Africa. So this is a business which gives you a credit rating. They therefore have a huge amount of information about you, and unfortunately that information has been made public. I have no doubt, however, that if that is the case, you would have received notice of that from your bank. There's a lot more scrutiny about this. And then, of course, there's this one, and that's data that you gave away. And in every single case, the thing that happens at the end of this is something expensive goes wrong. But the thing that is the most important to bear in mind here is that these 4 are not equal on the side here. These 4 things are not the same. We tend to think that it will be data stolen or lost or being watched or people being careless with your data that will get you into trouble. Unfortunately, it very often is data you yourself gave away, which is why, for example, the Investec Bank app now, before you pay anything, makes you actually click through this checklist and make sure that you are not being scammed. So it's very important to bear in mind. The most important thing here is we are generally the weakest link. The onslaught on our privacy is real. It's everywhere. It's relentless, and it can be very expensive indeed if you lose your banking details and your credit card is compromised. But let's look for a moment at a few of the others and how those have encroached and changed as well. This is a map of part of London. As you can see, that's the Thames. Those of you familiar with London will recognize exactly where this is. And this is just talking about surveillance in a very small part of London, less than 50 square kilometers. As you can see, it's an irregular area, 7 by 7. And it's a borough called Wandsworth, and it has 1,113 cameras in that small borough. You can imagine from that many cameras that it was once an unsafe place and is today a lot safer. Most of those cameras are recorded but are not analyzed or monitored live, but it essentially helps with capturing people after the fact. Now, the fact of the matter is that's not particularly helpful, because it's very often the case that people discover how to hide from the camera, how to disguise themselves, or indeed that in fact it's just too difficult to identify them and follow up on particularly petty crime. What is the real gold standard? It's using artificial intelligence and machine vision to constantly scan for crime as it is happening. So to give you an example, the artificial intelligence which runs the cameras in our road, I'm told reliably, and I think this might be just to get me to pay my monthly subscriptions, but that's possibly a discussion for another day, is that the machine vision actually picks up whether somebody is walking down the road and stopping at each car, which generally will mean that either they're very drunk or they're testing the doors to see if they can find an open car. And indeed, in the last 2 weeks, we have caught 3 people trying to break into cars, which is not something that has been happening before. In terms of catching them at any rate, they certainly have been getting broken into. Of course, what's always interesting is to understand how that is being achieved. How on earth do you teach a machine to see? Because it's quite difficult for a machine to tell the difference between, for example, a pony and a horse, or between a dog and a fox. But for us, it's really, really simple, which is why, in fact, what the computer scientists have done is they have pulled us all into the machine itself. Have you filled this in before? Have you clicked I'm not a robot and then clicked all the boxes that are not a bus, or have clicked all the boxes that are a robot or are a traffic stop, for example? You are in fact teaching an algorithm how to see better than it can at the moment. So we're all part of a live learning experiment that helps machines to see better and better all the time. So this is, of course, a very positive development. But, of course, being surveilled also has some negative aspects to it. And one of them is your cell phone. Now, you might think that this thing is a particularly safe form of communication, but it's really no safer than the old-fashioned landlines ever were. And that's because of this technology called an MC catcher. Now, an MC catcher is also called an MC grabber. And essentially what it does is it interposes itself between been around for a very long time. As you can see from this original version of the Israeli machine called the Stingray, which has now become the Hoover, as it were, of these particular things called MC grabbers. So what Hoovers are to vacuum cleaners, Stingrays are to MC grabbers. You can buy an MC grabber for as little as $1,800 on Alibaba.com. And that is in fact exactly what somebody did in Pretoria. And they used it to listen into personal conversations of Transnet people who were involved in tenders. And by doing so, they were able to blackmail these Transnet people and so convince them to send the tenders their way. One of those people has now gone to jail on the back of the testimony that was given recently in the High Court in Pretoria. So amazing story right here in South Africa, illegal surveillance right in your backyard. Putting this together, well, does this mean anything? Well, do you remember this movie, Minority Report? It was quite a long time ago now, 2002, 18 years ago. And what it spoke about was recognizing you as you passed through a public space, targeting you with advertising, and in fact, trying to work out whether you were a criminal or not. And of course, what it was doing was looking into the future. But if you put these things together today with what I've just told you and what I'm about to tell you, you will see that, in fact, life has imitated art. Targeted advertising is a reality to anybody who's done a search on booking.com and then been followed around by adverts will tell you. And pre-crime, as I explained to you with machine vision monitoring my cameras, well, that's exactly what we've got going here. Is it a reality? Well, anybody who's been to London will probably have seen this at least once, if not a few times. And it's called the Piccadilly Lights. And the Piccadilly Lights is, in fact, an enormous LED screen. It's 790 square meters of screen, and it manages to transmit 281 trillion colors. I didn't even know you got a trillion colors, never mind 281 trillion colors, but there it is, 281 trillion colors, and it reaches 100 million people per year. What it also does is it has free Wi-Fi. So what you can do is you can connect to it very much as you would connect to the Wi-Fi, for example, in the local shopping center or wherever you might be. And you would, by doing that, identify yourself to this machine. Remembering always, of course, that public Wi-Fi is the most insecure of them all. The most interesting thing, though, about this is not what you can see. It's what you can't see. It also contains 64 cameras looking back at the street. 64 cameras. Now, what on earth could those cameras be looking at? Now, the cynic in me says, what happens if you ask the Piccadilly Lights Corporation what they're looking for? They will answer you, we're looking for the ambient weather so that we can adjust the resolution of the screen. Now, I can smell that from here, and it doesn't smell like the truth to me. But what I do think it is, it's what we might see as the leading edge of what one day will be very personalized advertising at you right standing in the street using facial recognition. Why? Well, facial recognition is much easier than retinal recognition. It's ubiquitous. It's absolutely everywhere that you go these days, and it's super reliable, as anybody who's been identified in an embarrassing Facebook post can attest. It's very, very, very powerful technology, and it's just getting more powerful all the time. And it's increasingly now able to identify you from odd angles, or even if you're wearing a cap, for example. Just to give you an idea of how secure it is, think about the last time you went through passport control. It's probably a very long time ago now, given that we're in the middle of COVID. But if you go through Dubai these days, you don't actually talk to a real person at passport control anymore. You simply use the passport control machines. These are robots, effectively, that monitor, scan, and check that you are the right person who matches the passport inside the machine. They are not swayed by anything. They don't need to go to the bathroom. They don't get tired. They don't get grumpy. They don't like the look of you. They simply are checking whether you are who you say you are. So it's a fantastic security, not such a fantastic advance for job security. Of course, there's other ways in which this technology gets used that's really interesting and useful, but actually not that serious. Not sure if anybody watched the Harry and Meghan wedding in the UK when it happened live. And it was a particularly slow day, I'll confess, and I watched it on Sky News Digital in the UK in the flat that I was occupying at the time. And the most astonishing thing about it was not the wide variety of hats that you can see in front of you there. It was, in fact, the fact that as people were walking into the church, the camera was picking them up by facial recognition and identifying who they were so that you could see exactly who it was you were looking at. The old days of two talking heads on the red carpet telling you, oh, here comes so-and-so dressed by so-and-so, are long gone. That's all now done by a machine. It went even further in some cases by being able to tell you where they had come from by tracking publicly available travel information. That is simply astonishing. And again, on one hand, you think this is fantastic. I'd love to hear that Princess so-and-so has just come from Monaco. But on the other hand, I'm not quite sure that you would want that kind of information available to your crazy ex, for example. Bit of a worry there. The most amazing thing is that powering this is not who you think it is. It's actually Amazon. Amazon is the biggest player in the facial recognition business, and this is a huge part of their business. It's growing really, really quickly, and it's not only facial recognition, it's also machine learning and deep learning itself. As I said to you way in the beginning, you are the weakest link, though. It's not being surveilled, it's not illegal capturing, it's not the people losing information on your behalf. It's us giving away information, usually on your phone. It's amazing how much we give away just by carrying these phones around. I promised that I would give a small update on this presentation, which is now a year or two old, by mentioning conspiracy theories. And it's here that I must come in and say, it amazes me that people think that we need to have an injection so that we can be tracked by Bill Gates. I hate to break it to you, but Bill Gates, Steve Allen, and Mr. Cook, and all the rest of them are all tracking you already, and you're carrying the tracker around with you willingly every single day, taking photographs of yourself, where you're eating, etc., etc., etc. That time has passed. That ship has sailed. You have already been tracked. And most of it is being done by this location services. And why do we leave location services on these days? It's things like Uber and Uber Eats and Waze and Google Maps. Makes it possible for those to work, and hence we simply leave it on. And the thing is tracking us wherever we go. We track ourselves in other ways, of course, as well too. This photograph, which I shared on Facebook not too long ago, it was last year. As you can see, it was taken on the 23rd of May at 15:41, and you can see we've just broken through the clouds at our international airport. And this should tell you one thing straight away, and that's that my phone was not off when it should have been off. Amazing what you give away without even thinking about it. I was still sitting on my phone with it on, including transmission mode, while we were taking off. A little bit concerning, but anyway, it was pointed out to me very quickly on Facebook, as it usually is on these things. The technology is getting more and more personalized as well. This, for example, happens more and more often to me. If I pop out of our building, because I very often take an Uber to the V&A waterfront from our offices purely because of the traffic and the parking hassle, it now suggests it if I have the Uber app open. It pops it up straight away, as it does suggest the quickest way to get home for me. And the strange thing is this app, which is suggesting that I get home taking Helen Suzman Boulevard, is Apple Maps, which I've never opened in my life. So the sharing is going on in the background without me actually saying explicitly, at least I thought so, that the Apple Maps app could access my information. I obviously clicked somewhere on something that said I give permission for this to happen. And that's what we do every time we click on an accept terms and conditions or accept changed terms and conditions. Facebook is the best example, and I think we've had a very good insight into it over the last year, particularly things like photos, where you give away where it was taken, whether you tag it or not, it happens. When it was taken is automatically happened, and who is in it is tagged, whether you tag them or not. Facebook does know. I once went and checked how much information Facebook did have on me, and it turned out to be about 960 megabytes, about 3,600 photos worth of information. Now, that is a very large amount of information, since there were only about 180 photos on at the time. So there's obviously an enormous amount of information that's known, and it makes me quite nervous. And you think to yourself, what else do they know? Well, they know all your phone numbers, because Messenger and Facebook are one and the same business. They like everything that you like. They know everything that you like, the groups that you belong to, everyone you've ever been friends with, including the friends that you've unfriended, and everyone that you've poked at 2 a.m. in the morning or otherwise. It also knows, again, exactly like your phone does, where you have been, what location you were in, whether you checked in or not. If the app was open and you moved, the app knows. Also remember that from a Facebook perspective, if you delete information or delete a photo, for example, that information does not disappear off the internet forever. All that happens is it's made invisible to you and to others. To actually get this information out of Facebook and away from them completely is a lot more work than you would imagine. And I'm still not even sure that the information is all gone. Which brings me to this. You've watched The Social Dilemma, I'm sure, which is the documentary about Facebook, and shows you how cleverly the algorithm tries to manipulate you. And of course, it means that the things like fake news, for example, are a lot easier to transmit, because the algorithm realizes that you respond to a particular social information, a particular type of news item, a particular bent in coverage. So whether you're left-wing or right-wing, whether you believe in conspiracy theories or not, it does figure that out and starts to feed you more and more of these. And so it inflames the fake news story. But you still have an Instagram profile. So you might have deleted your Facebook profile in horror because it was a fairly horrifying movie, but people still keep on having other profiles. And I can sort of understand that you think that the Instagram profile isn't as rich on you because, of course, it's just photographs of yourself with very little else. But it's absolutely incredible how triangulating information gives a richer and richer view of individuals. And if you think that you've managed to get out of it by not having a Facebook profile, you're really not getting very far at all, because you also probably have a PayPal account. And PayPal is also harvesting data on you. You probably also use Google Chrome. And when you clicked OK on the terms and conditions and privacy policy, you clicked OK to them harvesting data on you. And here comes the really scary statistic. 960 megabytes was the size of my file at Facebook. The file equivalent at Google is likely 8 times bigger, because that's how much information Google harvests on you based on what you're looking at and interacting with on the internet. Google knows even more about you than Facebook did, and it's harder to get rid of them. So, as I say, sometimes actors are malevolent, though. Even though most of the time we are the weakest link, there are times when people behave badly, and more they've been caught out. The most famous one was this one. I'm not sure if you've ever actually seen it, but I saw it simply because I actually participated in it. This was the Cambridge Analytica scandal, which is where they illegally harvested and saved data of a number of people. How many people? 87 million profiles were improperly accessed, according to Facebook, and to which pro-Trump and pro-Brexit ads were sent in a targeted fashion. The company in total held 5,000 data points on 230 million Americans. That doesn't mean it knew 5,000 things about all 230 million, but it means that it was looking at 5,000 different things. And it had collected data on 230 million Americans. Considering that the whole total voting population in the US is 250 million people, that's a simply astonishing penetration. They literally knew America as well as anybody has ever known America. And they did that without obtaining permission, which is ultimately why they were deleted from the Facebook store. Because they didn't delete the data as they promised to. Facebook knew a long time before the scandal broke that they were doing this, and they did not accede to Facebook's demands. 200 apps have since been banned by Facebook in the wake of the Cambridge Analytica scandal. So the chances of you actually having browsed across one of these at some point is very, very high indeed. If I can just point out to you that anything that says, what does your favorite color look like? What would you look like as a wolf? What would you look like if you were a star sign? Any of those apps that purport to offer you something for free in return for nothing, you're actually giving away some data. You are stepping outside of the Facebook environment into that app's environment, and you're taking on all the risks that that involves. So be very, very careful when you're on Facebook or any of these apps and you see anything like that come up. Be very tempted to participate, but be very aware of what you might be letting yourself in for. Because ultimately, you are on your own in this regard. Regulators are helplessly outgunned. There was a large congressional hearing not too long ago where Mr. Zuckerberg had to testify before this hearing, and he was asked the most ridiculous questions. I mean, I won't read these out to you because you can probably read much faster in your head than I can out loud. But even the most senior litigators and lawmakers in the United States were not entirely clear on what they were actually trying to do. And the idea of these guys regulating themselves is becoming increasingly ridiculous. There's a very good article this week on Reuters about the monopoly power of these businesses and how foolish it would be to allow them to regulate themselves. So while they're wonderful businesses as a consumer, remember that as a citizen, they might have a different impact on your life. So you might ask, is there any good news? And there definitely is. A friend of mine reminded me the other day that there were times that you would walk around, for example, the waterfront or the Sandton City, and you'd be targeted by these Bluetooth adverts. I don't know if anybody else remembers these, but if your Bluetooth was on, you'd get an ad all of a sudden from the shopping center. It would be completely random and not related to anything you were interested in at all. So that was a complete pain. So it is a plus that we don't get that sort of advertising anymore. From an advertiser's perspective, they spend a huge amount of money. Facebook made $33 billion 2 financial years ago, and Google made $95 billion. I think Google's probably being a little inefficient given that they've got 8 times as much information. They haven't made 8 times as much money, but maybe I'm being too cynical there. But they make an enormous amount of money out of doing very cheap advertising, but very targeted to very small groups of people. These adverts are typically the ones that will follow you around. So once you've gone and looked, for example, at accommodation, you will see on the side panel of the Google search bar, or indeed even inside websites themselves, you'll see offerings that are similar to or even exactly the same as the one you were earlier browsing. These kind of targeted ads, stalker ads, if you will, are the ones that are making all the money. They look increasingly like this, very simple ads. This is one that's following me around at the moment. Strangely enough, I've only looked for one of the 4 things on here, and I'll leave it to you to guess which one it is. It's trying to figure out what else I would like. But it's pretty smart because there's at least one other thing that might be quite interesting. What are they doing? They're turning emotions and impulses, a quick little browse for something, into real money. So it's a real boon for businesses, including small businesses that previously couldn't reach targeted advertising budgets that big businesses could, are able to do the same thing now. And there are no good guys in this market, I'm afraid. On the 5th of June in 2018, Apple announced that they were upgrading Safari so that you could block tracking, which made them sound like really good guys. But then on the 6th of June, Facebook disclosed that it had already shared personal data with 4 Chinese handset makers, plus BlackBerry, Samsung, and Amazon, which of course was still making handsets in those days, and then of course it quietly added and Apple. In other words, you're not the good guys here. So again, just pointing out, you're absolutely on your own. You need to take care of yourself. As we come towards the end of my section of the presentation, just an interesting anecdote, pulling a few things together. I was in London a year ago when I walked past a hotel, and it was quite a small hotel in one of those areas where you used to get knifed, and now you got very expensive coffee instead. And as I walked past this hotel, I saw a very, very beautiful light fitting. And it was this one. And I went home and came back to South Africa, and I wrote to a friend of mine who owns a lighting company. And I said to him, I wonder if you could find me this. And all I did was I described it to him. So purely in text, in a Gmail account, I wrote, light fitting, this is what it looks like, etc., etc. What do you think? And he said to me, I think I know what it is, and don't worry, I'll see if I can get a quote for you. And it took him about 3 days to find that quote and to get the numbers together. And when he did, I'm very, very glad to report that the numbers came in at 230,000 Rand. And there is no way I or most people are going to spend 230,000 Rand on a light fitting. So it was an interesting exercise, mostly in understanding how weak the Rand is and how much it would cost to sea freight something that size across to little South Africa. What is the real story, though? The real story is that it took a real person 3 days to find this, even with all his experience and insight. He's a very experienced man who's been in the business for a long, long time. It took Instagram precisely 1 day to find me a knockoff from China and serve it to me at 2,723 Rand and 18 cents. It's a simply astonishing demonstration of the power of the internet, and particularly the power of these media companies. Needless to say, of course, it's slightly smaller. It's made of plastic, not aluminium, and I'm sure it's not going to last very long, but it is currently hanging in my dining room, and I'm very proud of it, not least because it's a funny story to tell people. As I say, you are on your own, but sometimes these things can work out. Even your DNA will soon not be private anymore. How do I say this? Well, you've probably seen these kits, which I don't think you can get in South Africa yet. And essentially, it allows you to take your DNA sample, usually from a cheek swab, and send it off. And for just $99, have your whole sequence sequenced. How do they do it so cheaply? Remember, this used to cost millions of dollars back when Craig Venter of South Africa first did it. Well, you've also given away the rights when you do that to your own genetic sequence. It becomes part of a public database. Those public databases are owned by people like Janif Ehrlich, who is an assistant professor at Columbia University, and who points out that you only need a few people related to you to illuminate a huge number of people. You can find your cousins, second cousins, and third cousins very, very easily, as many have discovered to their horror when they've done these tests, that they're related to people to whom they're quite close but have no relationship with at all. Brothers, half-brothers, cousins, and sisters, and businesses like this one, which is called MyHeritage DNA, has managed to pull together a database of 13 million people. Now remember, each person can illuminate 300 people, so 13 million by 300 is a lot of people, simply by scraping publicly available databases. Your DNA is not public anymore. To give you some concept of how many people 13 million is, CODIS, which is the FBI's official database, after 20 years of operation, only has 16 million people on its database. So it's incredible how much information is out there and publicly available. It's not bad news, though. This is the most amazing story to me, and I'm glad to share it with you today. It's about the guy called the Golden State Killer. And he was a serial killer who between 1976 and 1986 murdered and raped men and women across the state of California in the United States. In 2001, look at the time difference, 2001 to 1986, a breakthrough in DNA linked a set of murders back between North and South California. And it became quite clear that he had moved to Northern California and was the same person. In 2017, it was uploaded to a searchable database for genealogy. And in 2018, 1 year later, he was found and charged with 8 crimes. Searchable genetic databases, in this case, gedmatch.com, managed to put somebody in jail who should have been there a long, long time before that. An amazing situation of using a searchable database publicly available for great public good. What does all of this mean, of course? Well, the thing is none of this means anything at all unless we do something with the information. And what we do is we take these sorts of trends and we put them together with our bottom-up valuation of companies. We see whether there's something to be had as a story. And in many cases here, that's exactly what has happened. All this online transacting, including me buying that light fitting for that ridiculously cheap price, was done by Visa. Why? It's super safe and secure, and I know that my money will be taken care of. If I don't get the product, you're insured against non-delivery, and you can get your money back from Visa. And they deal with millions of transactions a second. So the vendor also knows that they will be paid, which is why it's the #1 holding in our portfolio called the Global Franchise Fund. All of us, as much as we love Apple day to day, I can assure you that most of us at work are using Microsoft Office in some form or another, and hence it makes up our #2. If we continue to go through this, you'll see a number of other technology stocks that feature very strongly as well, including the company which holds the rights to name every domain in the world called VeriSign. They hold .com and .net, which are the most important ones. There's one more that I'll mention, and that's ASML. And these two technologies, EUV lithography and DUV lithography, are what make it possible for chips to fit into something like your phone or your iPad. It makes it possible to make really, really tiny chips that are extremely powerful. And they're practically a monopoly in the world, and we own them. They've just been subject to corporate action, which has been very exciting to be witness to. And so this is the kind of thing that we are excited to bring to you, not just looking at these stories from an interest perspective, but turning them into something that means something and delivers investment value to you as our clients. So that brings me to the end of my presentation. I'm very happy to take any questions at this point. I'm not sure if we're going to moderate the questions or if I should just read, but I'm ready to take those questions.
Great, Steve. Thank you very much.
Pleasure.
That's a very interesting presentation, very scary presentation. I think firstly, where do you live, Steve?
In Cape Town.
in Cape Town. Okay, so I just need to make a note of where not to go and steal cars.
No, don't come and steal cars in my road.
If GMI doesn't work
We can
out.
watch you steal the car. We can't do anything about it, but we can watch you.
Okay. Are we helpless against all of this?
No, I don't think so. I think that there's two avenues through which you have to attack. You have to defend yourself. The one is the personal, and that is being aware. Simply things like not oversharing on Facebook, for example. So not sharing, for example, your birth date. It sounds really, really simple, but your birth dates, including the end date, can be put together with all sorts of other things to give you give people a false identity on your behalf. And then the other side of it, which is much more difficult because it's not as much fun, it's not as sexy, is being a concerned citizen. And that's being aware of things like privacy law, things like the POPI Act, which is coming in South Africa, and participating in that, supporting it where you need to, and making sure that privacies are protected by legislation as well, because that's ultimately what will keep us safe.
Yeah. We had a question from Roland. Roland wanted to know if how we can avoid such shadowing.
Yes, it's super difficult.
Yeah. I watched a video where a guy took a phone, put it on flight mode, and was able to see that the phone had tracked his movements while he was in airplane mode. So even he had two phones, the other one was switched off, and both phones tracked him.
Yeah, absolutely.
So
nothing would surprise me. The short answer is the only thing you can do is leave the phone at home. Leave the phone and apps at home, because you're not in control of those things. So if you truly want to not be shadowed, that's the only way to do it. But I don't believe that that's entirely necessary. I think that most of us have given up something in return for something, and that is convenience of some kind, or a service of some kind. You have to moderate it. But unfortunately, if you do want to completely avoid this, you have to leave all the tech at home.
Okay. And Dudu asked if going incognito, does that help?
This is a very controversial thing, because going incognito hides your browser history, for example, in Chrome, from yourself. But it doesn't necessarily hide it from Chrome. We don't know for certain that it does. So all these things do help, but ultimately only using some of these really encrypted browsers are what will help you. And the internet has details of some of those. So using a virtual network to give yourself complete privacy, and then using a secure browser is the way to actually make sure nobody is tracking you on the internet. And even then, I would be wondering, is the browser maker not tracking me? But
yeah. Okay. And then Lesego wanted to know if your 91 Global Franchise Fund available on Easy Equities.
I'm not sure. I will double check for you, and we will come back to you.
Okay.
I think my colleague Jacqueline might be on here at the moment. I'm not sure if she is, but perhaps Jackie can answer it. But we will come back to you during the course of this day.
Okay, no, we can give Lesego feedback directly.
Perfect.
So would getting the Nokia 3310 help?
I don't know what it would help, but it would definitely help this.
I'm sure
you might get a little frustrated.
Okay.
Lovely.
Yeah, we haven't got any more questions. So, Steve, from our side, thank you very much.
Thank you.
Most enjoyable. Just to say to our clients that the Global Franchise Fund is on our shopping list. It is a fund that we've been putting clients into. So some of you are familiar with the fund because you are already invested in it. And we've been very happy with the performance.
Super.
So you guys can keep
glad
that up.
to hear it.
Make our job a bit easy. Thank you, Steve. Much appreciated.
Super. Thank you, and goodbye, everybody. Thank you for listening. Take care.
Our next speaker is Cy Jacobs. We are very excited to have Cy join us and handle the more market-related stuff in terms of what's happening on the stock market, how are they seeing this COVID crisis playing out, and what are they doing in their portfolios, what do they see coming down the line. Just a bit about Sai. Sai is a co-founder of the 361 Asset Management. He heads up the investment team. Before 361, he was a portfolio manager at Investec, where he was head of the opportunities mandate. Prior to that, Sai was a director at HSBC, where he jointly managed the Nedbank Entrepreneur Fund. Sai completed his accounting articles at Kessel Feinstein, which is later acquired by Grant Thornton. So, Sai, I'm going to ask you to switch your camera on, and I think Jackie is going to load the presentation. But Sai, thank you for your time. Thank you for joining us here today and addressing our clients. We're looking forward certainly to. I need to just change something here for Jackie to be able to share the screen. There we go. And
thank you, Craig, as well, just for giving me time to speak to you this afternoon. On behalf of 361, to all of you, I hope the information we're about to present is meaningful. Please ask us any questions. We can deal with them at the end. And thanks again to GMI.
Great. Thank you.
So just some quick history on where we come from. I mean, myself, been in the market for almost 23 years now. Started HSBC, as Craig mentioned. This business, 361, was launched in 2004, and we've been running for almost 16 odd years. Launched various funds along the way. I'm sure many of you maybe heard of us before. We have many unit trusts, but we're also the largest hedge fund manager in South Africa. We have various funds. We kind of are split between hedge funds, which we'll deal with, which can do other things besides your traditional unit trust, which we call long-only funds, which can really just buy and hold shares or buy and hold other instruments. We have various domestic unit trusts, a flexible fund, a general equity fund, SA equity fund, a balanced fund, which we manage actually on behalf of PPS, and more recently, a global equity feeder into our offshore fund, something that would compete, I suppose, against that fund you just saw from Investec a few minutes ago. And on the right-hand side, we have various hedge funds. We've been running our flagship hedge fund for some 15 years, which has done very well, about 50% per annum better than the markets, about 15% per annum. Probably better than any long-only unit trust in the market in the whole of South Africa over that period of time. And more recently, we've launched something Craig wanted us to speak to, an absolute alpha fund running for 2 years, which is even a far safer option, trying to really beat cash by a reasonable margin. And overall, just a very diverse array of products across both long-only and hedge funds. We're pretty small, so like NinetyOne, who probably manage 2 trillion rand across the globe and maybe 400, 500 billion rand in South Africa, and maybe even 200 billion of equity money. We manage some just over 20 billion, so a lot smaller, but in our mind, a lot more nimbler, makes us more flexible, we can change our mind on things. South Africa isn't a very liquid market, so we can move around between stocks and sectors. And obviously in the hedge fund, we can make money out of things that go up as well as things that go down. So we have an extra universe of opportunities in the hedge fund that you don't have in your traditional unit trusts. We have, just like in Investec or a NinetyOne or a Coronation or Allan Gray, a very extensive investment team. 11 individuals headed by myself and Evan Walker, both of us 23 plus years in the market. Many of our other investment professionals with 10 to 20 years experience, and a few very young sophisticated, smart, intelligent youngsters who've come really top of their university degrees. I mean, mentioning one, for example, like Tumi, who's a BCom, BAc, honors, masters, and then a master's in commerce after that, and an MBA at Oxford, and all of that done cum laude. So finding really top quality people, and not only from a degree point of view, from a sophistication point of view, but those who can really specialize in various sectors of the market and find those good and bad opportunities. Just a small operations team, and my colleague Jackie on the call as well today. Anything you need to know is to speak to either Jackie or Stash, who handle all our distribution. Really, just also a small background on some of the things we do from a social responsibility point of view. For 15 years, my partner and myself have believed in trying to uplift both education and sport. Education is obviously the foundation of any economy and absolutely important. So we put a lot of our extra spend into education. And we know sport often brings people together from all walks of life and cultures. And so the two have been a very big focus for us. And some of the initiatives we've supported over the years are listed below. So what are we about and how do we invest? Well, I think we're a little bit different to maybe most companies, is that, instead of building a spreadsheet and trying to work out what Barlow's or Standard Bank will make next year, we consider the qualitative side and the board and management of these companies at the outset. When I'm saying the qualitative side, we all living in South Africa. We know the state of the economy. We know the state of various industries. So really it's trying to find a business within an industry that has something sustainable, where it's come from, where it's going, that has a management team that's aligned to us, that's invested alongside us, not actually just making money, and being compensated as managers for regardless of their performance, but rather being co-invested alongside us with the right strategy, with the right ability to allocate capital, and ensuring that that capital allocation brings adequate returns, and ensuring that that board has proper independence. So in South Africa, had you covered aspects 1 and 2 here very well in the past, you actually wouldn't have even needed to run the numbers of any of these companies or stay involved. You would have avoided the likes of a Steinhoff, for example, who was in declining big box furniture and had no independence on their board, for example, and allocated money in ridiculous fashion. So, a simple check of your first 2 numbers here, in many cases for us, has been key in determining that we invested in the right businesses, in the right industries, and miss all the landmines. And there have been many landmines in South Africa over the last number of years in many companies and many industries. And I can honestly say that, we're up there as one of those companies that luckily have pretty much missed most, if not close to all of them. After we make an investment decision, we like to stay actively involved. And then what we call our next slide is really what we call the short of it, is looking for opportunities. And these are hedge fund opportunities predominantly. And for those of you who don't understand really what a hedge fund does, simply a normal unit trust or a normal portfolio buys shares with the hope that those shares go up. In the hedge fund, you do that as well, but you have the ability to borrow shares that you don't own and sell them in the market and hope that those share prices come down and make money by then buying those shares back and returning them to a pool that you've got those shares from. So effectively, you have a bi-directional investment strategy. And this part of the game, this part, the avoid, is trying to find those companies with untrustworthy management teams or complicated businesses or earnings where, for example, there's no cash flows, or businesses that are reliant on a particular line or client, and trying the best we can to measure if these businesses at some point in the future, and hopefully in the near future, will come short in some way. And then obviously their share price will be affected, and we would like to make money from those opportunities as well. Given where South Africa's been the last number of years, there's been a lot of these type of opportunities, not only the Steinhoffs, which have obviously been like blatant frauds, or the EOHs that have collapsed, But there have been many companies in the industrial, in the banking space that really have, just come across hard times, either because of the economy or just an overcapacity point of view. But some of the things mentioned on the slides here are just areas we look out for that may heighten our awareness and try and hone us in on a next opportunity. I mean, just the one I would mention quite a lot of is we're seeing is where a lot of companies have earnings but little cash flow. And we were screaming from the rooftops in 2017 that the property sector, the entire property sector on the JSE, had lots of earnings but no cash flow. In other words, they should have just earned their rentals, less their normalized maintenance expenses, and that's what you should have got out as a dividend. But in fact, they were revaluing their properties up every year, raising fresh equity, buying more properties, too many accruals, too many sophisticated swapping of equity for other equity and cross-currency swaps and all complex mechanisms to enable them to continually paying out higher dividends, when in fact the deterioration of the rental income and the buildings and everything they own had already started in the year or two before that. So it's very understandable that not besides COVID, that the property sector, was one of those that really was a great short opportunity from 2017 to now. And, it's probably down some 70, 80% from the peak if you look. And many companies have gone, almost 100%. So what we do in the hedge fund, we try and keep everything quite simple. So as I mentioned, you buy shares that hopefully will go up. You short shares that hopefully will go down. Those two actually act as an independent balancing pendulum, call it, against each other. So if the markets do correct at any one time, hopefully your shorts and your longs go down together. Therefore, you are quite protected. Your capital stays intact. For us, liquidity is always constantly reviewed because when you buy something, you want to know you've got the ability to sell it if things change. The same time as if you go short, you want to make sure you have the ability to cover or buy it back, very easily. You always, in a hedge fund, like you should do in a normal unit trust, is be cognizant of your concentration risk, how much you, for example, have in property or in banking or in industrial businesses or in mining, because, as you know, things can change and things can change quickly. I mean, COVID accelerated, many things that were happening around the world. But also industries that were declining, it accelerated that too. So understanding your exposure across various sectors of the market is very important, and sizing those individual positions within a portfolio, especially your shorts, is also paramount. So just moving a bit on, and you asked us to discuss a bit like how we're seeing the world and what the world holds for us. And during COVID especially, I think living in South Africa, you get the sense that, everything has ground to a halt, and a lot of the stimulus you're seeing around the world is not actually resulting in any real economic uplift. But in fact, what's happened, interestingly enough, in China is that we've seen some very interesting numbers coming out of China. Their total power consumption, for example, in the current year is at an all-time high relative to previous years, which shows that there's a lot of manufacturing and industrialization happening, new building, excavator sales, which is something we monitor quite closely, although had a very big drop, is not any worse than any prior year. In fact, is higher in units, which shows you that there's not as much of an effect globally as we would think living in South Africa. And I think that's largely what's gone to, besides the stimulus, recovering many of parts of the market. And in fact, in many of the technology companies and other global leading companies, we've seen obviously a massive recovery even during the period of COVID. So you look at China's property sales, private property, and new starts. You saw a very big drop-off at the onset of COVID, but a massive recovery. So we've seen a really big recovery, not only from a stock market and pricing point of view, but an actual activity recovery, which is showing a very big V-shaped recovery. And had you asked us even at the beginning of COVID, had this been the case, I would have said absolutely not. But interestingly enough, there are pockets of real boom happening around the world. Also, what's come about, and I suppose this is logical, but also not really thought about much going into COVID, is that obviously unemployment accelerated. People had to lay off people. Businesses have closed. And you're really not going to see that, in my view, come back to anywhere close to it was, for a number of years, because also the acceleration of technology and technological businesses has made a lot of old-style businesses redundant. So you would anyway expect that unemployment rates, unfortunately, will rise. But it has commensurately happened that a lot of savings has resulted. People have obviously stopped traveling around the world, stopped buying luxury goods, stopped eating out at various restaurants. And actually, interestingly enough, in the US, EU, and Japan, the savings rates picked up quite significantly. And I think that's something that's very interesting. And that's also what's driving, obviously, stock markets and higher prices, because there's a lot more disposable income at hand and a lot more available to invest. And rates continually around the globe have continued to drop. So we've started seeing record property months. In fact, the UK just put out a number yesterday showing a highest increase in property values for some time as a result of obviously higher savings rates, lower spending, and obviously the commensurate with much lower interest rates. So not all doom and gloom. Together with the fact that obviously central banks have pumped trillions, specifically the US, into the marketplace, the Fed, the ECB, and the Bank of Japan, really stimulating to a ridiculous level never seen before in the history of this world. And as a result, we're not really sure if this will create inflation or not create inflation, but we are quite sure about one thing, and we think, is that the gold price should materially improve because the value of money has deteriorated so much with the printing of so much money, and rates obviously being very close to zero. So for us, gold's been a good hedge against all of this. It has gone very well, and we've held it for some time, and we still think that there'll be some positive momentum in gold. Whether Trump or Biden wins, in our view, stimulus will continue, specifically in the US. One of our big investments has been rather a poor investment over the last couple of months, but been very good for us over 15 years, has been Naspers. And Naspers, obviously, his main asset is Tencent, Chinese internet business, the biggest single Chinese internet business listed in Hong Kong. And interestingly enough, what we really feel is quite exciting is that Tencent has actually underperformed, specifically a lot of the US tech shares over the last number of months. It's done okay, but you've seen tech shares go absolutely crazy. And it's interesting when you look at what's happened to the real revenue that Tencent is booking over its accounting revenue, you'll see that there's more and more growth in deferred revenue. It means that their potential is growing more and more and faster than it was in the past against its accounting revenue, which tells us that there's only good things to come. And unfortunately, the discount to Naspers has widened, but to 55% actually to its value in Tencent. But I think, for all South Africans living here, looking to own something for the long term in technology, in South Africa, in rands, Naspers is probably still the single best long-term investment one could make. Looking back at the South African macro, I think a rather different set of numbers to what you're seeing out of specifically China. Very frightening to know what's happened to our public debt as a percentage of GDP, and very importantly, what is making up that debt and how to effectively turn that debt. So, this is a frightening graph, and stabilizing this requires some very big moves. Cutting payroll expenditure for government employees would be an absolute must if to bring this even on a flatter trajectory, and obviously, that would come with, massive upheaval. We need to bring down our borrowings over time. Luckily, interest rates are lower, so we are managing to borrow at a slightly lower rate. But we have also an increasing level of unemployment, which means we're going to have more SASSA payments. So between SASSA, our interest bill, and our public sector wage bill, we really don't have much space for any revenue to be invested in infrastructure or any growth initiatives. In fact, we've got a shortfall just to cover those three at the moment. So really a worrying situation. And, you know, our GDP doesn't look like it's going to bounce back at any time. All this extra debt has not resulted in extra GDP. Like in many of the other countries where debt is rising, at least you're getting GDP growth. Here, we're not. So obviously, we've seen a big reset in GDP this year. Whether it's 10% or 12%, doesn't really matter. We will see a big bounce, I suppose, off that in the next couple of years. But we're not predicting for that GDP to come back to 2019 levels for probably another 2 to 3 years. So overall, not a great picture. And if you look at the contribution from GDP growth, not great. I think this is something I mentioned, in the first part, but our government wage bill as a percentage of the total country wage bill, has been rising to an absolute ridiculous number, and is causing a massive issue with our overburdened debt in South Africa. And as a result, there are some big decisions that need to be taken and big steps that need to be able to move to get this country back on the trajectory it was. Just looking across what's happened, we saw a report out a few weeks ago at the various provinces and the various municipalities of which provinces have had unqualified audit outcomes. I mean, it's interesting that the Free State has got a 0. I mean, only the Western Cape at 79 is showing any hope of having a reasonable audited municipal functioning city. The rest, deteriorating even further off very low bases. So very troublesome. Not sure how you get to grips with this. The amount of wasted spending continues. And really there has to be something done about this, because we're on a steep, sharp decline in this economy. And it's not to say that you can't make money investing, because that still means that there's lots of opportunity for potentially shorts and for potentially maybe the rand to weaken, and lots of rand hedges luckily are listed in South Africa. So it's not doom and gloom from an investment point of view, from an economy point of view, and an employment point of view, and a sustainability point of view, rather worrisome in South Africa. So turning back to our hedge funds, I just said what we can do in a normal unit trust, you can only buy and hold. In a hedge fund, we can buy and can go short. So we can make absolute and positive return even in bad markets. And I think that's very important. You've got an ability to do other things rather than just buy and hold. I thought I'd explain it to you like this, in case there are people on this call who don't really understand the whole process of shorting a share. So we decided that Sasol was expensive at 300 Rand some year to 2 years ago. We didn't hold any Sasol shares, but we wanted to make money on Sasol going down, because we realized management were poor, oil prices were at a high, their big project in the US, in Louisiana, was going badly, costing them more. So we borrowed shares, someone else's shares. We don't even know whose shares they are. It's not really important. It's electronic. You can do that, and you could sell them in the market for 300 Rand. And we waited. And during COVID, that share went actually below 50 Rand. When they got to 50 Rand, we bought back the shares and delivered them back to the people that we borrowed them from. That all happens electronically, so nobody knows we're even doing that. Why they would lend their shares out? Because they actually make a bit of money from us. We pay about 1% a year to effectively borrow shares from this pool. So we borrowed shares, sold them at 300, bought them back at 50, so we made 250 Rand profit. The important thing there is we haven't invested 1 cent. When we sell at 300 Rand, we actually create 300 Rand of cash out of thin air, but we have an obligation at some point in time to get the shares back. When it falls to 50, we get the shares back to the pool, and we make the 250. Now, if we can find those kind of opportunities, we obviously can add extra potential to the hedge fund and add extra profit for our investors. And obviously, when markets are weak, it's these types of opportunities that we particularly are looking for. So how we currently position and what we like and what we don't like. So the majority of our fund, because we're a little bit anti, as you can hear, South Africa, we're in rand hedges, we're in dollar earnings. We think that's better insulated against what's happening with the virus. Technology is our largest exposure, both in South Africa and internationally. We like gold because they're good hedges against the stimulus. We have very limited exposure to the South African economy, so property, banks, retailers, industrial. But we are increasing where things get ridiculously cheap. So we're buying Standard Banks around 100 Rand. We were actually buying one or two property companies that have got ridiculously cheap. And companies like Bidvest and Motus, MultiChoice, where they're companies that we think are decent, but are just really struggling in this environment that will come out of this in a reasonable state. And really, it's about those companies that have strong cash flow, good balance sheets, and in some of these cases, we're happy to even follow rights issues. So in the likes of Foschini, they were buying Jet out of the liquidated Edcon. They wanted cash at $60. We went into it, went up to 85. We're out of it. So we're a business who uses our size and our flexibility to take advantage of those types of opportunities. And we obviously will take, looking for businesses that will take market share, like in a downturn, like Foschini did, when others are say, liquidated. So if you look in the last 12 months, what we've really done, we've increased our technology. We've actually bought into a bit of asset management businesses in financial services because they've been doing quite well. More golds and PGMs, and then just some other things we've done in reducing positions. We added some insurance shorts, and we eventually sold out of our platinum preference shares based on the valuation that Northern was actually paying us. So did exceptionally well out of that, and probably one of our best profits, in the year. So one of the things I think Craig asked us to talk about is another fund that we've launched more recently. That was launched in July of 2018. This is a fund with a very much absolute mindset. So we're looking to really beat cash by using the market, a highly kind of traded fund. So it goes in and out of lots of opportunities, got lots of longs and lots of shorts, but doesn't hold any of its positions for any longer term gains. And a lot of the cash sits in high yielding opportunities because we don't invest on a net basis any cash. It can invest in offshore, but rarely does, only if it can on for a short-term opportunity. And really its idea here is never to lose money, but to try and beat your cash by maybe 2 to 3 times in a given year. We see a lot of opportunity in a lot of stocks that move around. So, the team who manages this fund has the ability to, see, for example, that today, there's been a huge seller in MTN over a few days, and it's coming to an end, and it's underperformed its peers by, 5 or 6% over 3 days. So this fund would take a position and probably, take a short position against that in one of the other stocks in the same sector, and then unwind that position maybe 2 or 3 days later and look to make just a few percent out of each single trade. So not looking for big margins, but looking to just continually add little small basis point returns every few days to the performance of the fund. And it's done pretty well. So if you look at what it holds currently, this is obviously in a point in time. It holds some prefs, some bonds, very small exposures in some other companies, some very small short exposures, but obviously those could change within a day or two, because this was a snapshot given to you at the end of September. But just to move on and show you how the fund's done and where it's positioned, you can see, not big exposures, not big long exposures, very tiny shorts, and overall a very low risk type fund with a very low volatility. So those of you who follow the volatility of funds, you can see this is the performance trajectory of the fund over its life, over two and a bit years. Really only had one bad month, and that was March. And really that was only as a result of the credit instruments it held. So for those of you who were in, any income funds, for example, that marketed their daily bonds, there was a big blowout in bonds that month, so things moved. But as you can see, over the next 2 to 3 months, it kind of made back the same profit that it lost. It was really just to the point in time. But overall, this fund has done phenomenally well, in this climate. So I think, first of all, one of the big things, and I mentioned to you as well, is how many companies have done so badly over the last 5 years. And many of you, unfortunately, on the call today have probably been held victim to some of these. I think for us, this has been a profit pool. So unlike our other competitors, this is the additional subset of shorts. I can't say we weren't long, maybe one or two of these companies in the last 5 years for a short space in time. But these companies have generated a lot of profit for the 361 hedge funds. And we were short many of them. And some of them, like Brait, short, and held for 90% of the decline. So, I mean, it's been a pretty good pool of success for us. If you look at the hedge fund over its life, and this is our main hedge fund that's been running for 15 years, this hedge fund, if you look at how there's been in the entire 174 months of its existence, which is obviously a long time, in 105 of those months, the market went up over 3% on average, and we only gained, say, 2 and a bit percent because we're more conservative. We don't have all our money invested in long positions. We have shorts. We're holding a very low risk portfolio. The important part is when the market went down, in 69 months, the market lost greater than 3% on average per month for those 69 months, and our hedge fund was almost dead static. So really protecting the downfalls when the market comes. As a result, when you put the two together, it might not look like much, but if you're making an extra 4 or 5 or 6% per annum against the market, and you compound that over 15 years, you're making multiple times your return that you would make of being passively invested in the market. Also during COVID, so you can see we made money in January, hardly lost money in Feb, hardly lost money in March against the market. It was down some almost 30%, the cap swings over the same period. And it's by avoiding those downfalls that really gives you the biggest long-term, return. Because obviously, if you lose 30% in a market, you're down to 70. You need almost 45% performance just to get back to break even. So I think the key in a longer-term portfolio is really missing out on the big negatives. It doesn't matter if you don't make the huge positives. You want to make little bits all the time, over time, and eventually that compounds to a properly big number. If you look at the volatility of the fund, for those of you who measure it, in 2008, the market lost 40. The worst case this fund was ever down was 12, and that was from peak to trough, so it wasn't in a single month. It was quite a few months, and obviously the market was down 40%. The hedge fund runs at about half the volatility, which means that if you measure it from a risk point of view, it really measures very well against the market. Also, just looking at the correlation of the market. So, since inception, only about half the correlation of the market, and over the last 5 years, even lower than that. So, generally, market moves are not what's moving our performance. It's our selections of our longs and our shorts. But just finally on the performance and what we've done. So, this is on the Absolute Alpha Fund, which is one I mentioned first, which is a very highly traded fund, the one that only had one very negative month of 4%. Even with that, it's up 9% year to date. It's up over 12 for the last 12 months, and it's annualized, even though it's a short period of time, just over 2 years at, over 18% per annum. And that's when the market's given you basically zero. And the important thing there is that the volatility is so low. I mean, it's basically a third of the market. So it's giving you a proper return where the market's given you nothing, and it's giving it to you, with a lot less volatility. Our main hedge fund now, which is the big fund, the largest actual fund in South Africa, been running for 15 years. And you can see, had you invested in the market for those 15 years, and you put, let's say, I think R1 million in today, you'd have, you made 280%. So I think you'd have, 3 to 4 million rand. And if you put R1 million into our hedge fund, you would have made 740%, I think it is, which means you'd have 8.4 million. So, instead of having 3 million, you've got 8.4. So you've made, almost 2.5 times more than you would have made in the index by being invested in our fund. And that's net after all our fees. So the fund's done phenomenally well versus the market and done it with a lot less risk, which is what's important. The risk has been, basically half. We launched a retail version of the same fund. So the fund that you just saw on the last slide, which is running for 15 years, has now been running for four odd years in a retail version, meaning it's a unit trust, meaning you can buy and sell it on any single day. It's available on most platforms and now actually just gone into the Alan Gray platform. But it also can be invested directly with ourselves. Craig would know all the details around that. But again, the same kind of performance and with a very low volatility. What is important as well is to know that if you are looking at hedge funds, is to know you can't look at any hedge fund, because if you look at the bottom two graphs, the bottom two lines, that is effectively the average of the market and the average of the hedge fund, total hedge fund index in South Africa. So actually, all the hedge funds aggregated together have pretty much not outperformed the market. The red line is our hedge fund. So obviously we've done phenomenally better than the average and obviously a lot better than the market. So just caution you that not all hedge funds are the same. There are some other good ones out there, but there are more bad than good on average. So you really need to do your homework. And then just a quick summary on all our funds. Our general equity fund, which keeps showing up, in the market as close to number one over 1 year, 3 year, 5 year. Since inception, it's done phenomenally. SA equity fund, which has pretty much beaten, all big SA equity funds and all the other big names that you know of. So I won't mention them, but it's ahead of all of them. Our flexible fund done very well of late, done pretty good over time. Hedge funds, which I've mentioned here. And we have our global fund in dollars at the bottom, which is our long-only fund, which would compete against the one you saw from NinetyOne. As I said before, we have that now in a RAND version, available as a global feeder fund. So thank you. I hope I wasn't too long. Spoke for quite a while. Still got time for questions. Craig, if you'd like to just lead it off.
Great. Syed, thank you for that. I think incredible that you guys have been able to deliver those kind of performances given the markets that we've had over the last 5 years. I think it's certainly been it's been one of the toughest 5-year periods I've seen in the 20 years I've been in the market. Would you say that you would have struggled if you were a lot bigger to navigate over the past 5 years?
Definitely. So I think size does help a lot in our favor. We watch obviously share registers closely on a monthly basis, and I see the struggle that some of the bigger asset managers take, because I see when they start selling, they generally carry on for months and months.
Yeah.
And in many companies today, outside of maybe Naspers and a few big stocks, very difficult to actually do what you want to do in a short space of time.
Yeah. Okay, I'm going to let Gradidge ask his question. He had a question to put directly to you. Gradidge, if you can unmute. There we go.
Yeah. Good afternoon, Sai. So my question is, our greatest dilemma as financial advisors is more managing our clients' emotions more than anything else. So it's through the difficult times, through the deep market drop when COVID started. So there's a talk of so I'm going to ask you a two-part question. One, there's talk of a second wave of COVID coming. Okay, so the first question is just comment on that and what your guys take on a second wave coming. And then the second part is, if it was to happen, what would your suggestion be to our clients and how they should behave? Should there be another COVID, a second wave of COVID happening and potentially another drop in the market? How would you ask them or suggest that they react were a second wave to happen?
So firstly, I think even if we get our second wave, and South Africa probably will have a slight uptick in the infection rate we currently have, because we have unlocked and we're coming into summer, and there's going to be more people going back to work and socializing. So there could be an uptick. I very much doubt if it will be strong enough to even be considered a second wave, for the simple reason we have a very actually healthy population of young people, so with a very young age on average. And if you look at the statistics across the countries that have had second waves, generally all the heavy second waves have been in countries where the average age has been a lot higher, and the obesity rates have been very high. I think on average, the average South African here, even if he or she contracts COVID, is largely unaffected. And unfortunately, I think we should have never locked down for as much as we did in the first place, but we did obviously cause a lot lower death rate and a lot lower infection rate. But I cannot see our government locking up again. So even if we were to see a slight uptick and call it a second wave, I would not be fazed as a South African. And given the fact that we have sporadic second waves globally anyway, that would not all be happening at the same time, I wouldn't change any of your investment strategies. I mean, if we happen to have a second one in South Africa and a slight uptick, we're not going to be driven by what happens here. Our South African market is driven by Naspers and Richmond and mining stocks and other rand hedges, and whether the banking stocks fall by a few percent and some other retailers fall because we have to lock up alcohol again, kind of insignificant. So I would tell the investors, you're invested for the long term in good businesses that are going to, continually evolve and embrace technology. And over time, it's very difficult to predict when to disinvest or invest. And a lot of people got scared in March and disinvested and sold out of portfolios, only to find out that many companies a few months later were at multiple times what they were pre-COVID. So I think that you've got to be careful to disinvest. But I think the more important question is where to invest. So, I still believe equities will be good, but I think, trying to avoid those that are in old industries or in countries where there is no growth like SA, is probably warranted.
Thanks, sir.
Thanks. So you spoke of the landmines that you guys managed to avoid. Do you think any of those that stepped on those landmines could recover? When you look at the likes of, I think EOH has been quite vocal, or the CEO has been quite vocal in terms of, the unfair. Okay. Do you see any of these companies potentially recovering?
An EOH can't ever recover to what it was. I mean, I think it was once $180. Hit a low of 4 or 5 rand, where probably it's still now. So, a cleaned up EOH with let's call it, I think in total they had like 60 different businesses. A cleaned up version where they sold 30 or 40 or liquidated some, got rid of the debt. It could be worth maybe 10 to 20 to potentially 30 rand, but never getting back to the previous highs, because it wasn't based on fact. It was based on fiction and overcharging via sourcing businesses to government. And we were actually the ones who challenged the company at the outset in, I think it was end of November of 2017 or 18, I think it was 17. They were on a roadshow. The share price had dropped to 110 rand, and people were concerned. And I went there with a list of questions and started asking questions. And the meeting was abruptly kind of adjourned, and they cancelled the rest of the roadshow and wouldn't answer the questions. And by the following week, the share was down to 60 rand, and that's when the fall, started. And I think, questions couldn't be answered. And unfortunately, in South Africa, we believed that many of these companies were real until a number of years ago. Then we saw the Steinhoff collapse to start, and people started asking questions, what other Steinhoffs are out there? And the truth is there were quite a few. And we will see recoveries of some of these other shares. I mean, some in the property sector, I think if they do make it, they've got the potential to double or triple from where they are now. But they probably won't get back to, where they were at their peak ever, in my view.
We had a question from Roland, but I think you answered it. You may have asked before you answered. Assuming the track record you showed us as gross figures, but you did indicate
it's net.
They were net of fees.
Yeah.
What is the fee structure? Okay, so your fee structure, you are one of those managers who charge performance-based fees.
Correct.
If you'd like to talk us through your thinking.
Sure. So it depends on which fund, what the performance fee and fee is. So, all our funds are a bit different. We do have some funds that don't charge performance fees, but then they're not hedge funds. Our general hedge fund, like the retail investment fund, which is a unit trust, charges a 1% management fee, and it charges a 20% performance fee above cash hurdle rates. So as long as we're delivering above cash, we would take 20% above that cash, obviously with a high watermark. So any time that your performance dips under, you'd pay no fee until such time as you've recovered your losses plus made the hurdle again. So, to give you an example, I always quote this example because people say, well, you charged me a lot of fees in 2007. So we were up 30% in 2007 net. And then in 2008, we lost 10%. But we lost 10% and interest rates were 10%. So actually, by the end of 2008, you're 20% behind your benchmark. And in 2009, we made 30% back. So you'd only lost 10 in 08 and you made 30 in 09. But in 09, you don't pay any fees because you had the 10% to make of 08, loss, the 10% interest in 08, and the 10% interest in 09. So you add them all together, you've then got to make 30% after losing 10 to make fees again. So it's a pretty fair system. I mean, we're only making performance fees when clients are doing exceptionally well. And obviously, the more fees we make means the better net performance our underlying clients will get. So we feel the alignment is correct. And, hedge funds are pretty much run on the same basis in South Africa and globally everywhere. The only real difference, some funds do charge more than 1%. We charge only 1% management fee.
Great, thanks. And then I think the final question from Billy, he said, has the huge amount of COVID bailout funds resulted in overvalued equities? Is there a crash coming? If you were retiring, what proportion would you invest offshore as opposed to locally? It's a fairly broad question. But,
okay, so I do think that the COVID crisis and the stimulus has obviously found its way back into markets in a big way. If that stimulus were to stop, I would say the markets are at risk in the short term of coming down significantly. But I think that the powers that be recognize that would be another unstable situation that they would not want. So the stimulus, in my mind, will continue regardless, whether it be Republican or Democrat, because it's important to just continue to stimulate and get the economy and the world moving, post this COVID crisis. So if you tell me it's going to stop and I'm no fortune teller, then I'll tell you it's coming down. If it continues, I'd say the market will continue at a steady pace. I don't think you're going to see the type of growth you've seen over the last few months because the acceleration that we've seen and deceleration in various industries versus other successful industries has been so significant over this period that we've seen a great stock market, but actually you've only seen it in some opportunities. So if you stripped all the technology stocks and biomedical stocks and robotic stocks and all the new various fancy things around fuels, etc., and hydrogen, if you stripped all of that out, the balance of the market's probably deteriorated, even globally. And we've seen here in South Africa, our banks are half of what they were, our property companies are a quarter. So it's not something that's only happened from the stimulus, it's happened from this acceleration and deceleration in different industries. And I think it's going to be a call on how much stimulus, but I wouldn't be that concerned about the overall market in good businesses that are in good industries that are growing. The second question about your retirement funds, I'm just one who actually believes that if you can find the right, good international funds, and you can access many of those here. I mean, we have one I think is quite good. I'm sure Craig's got many. I would prefer to be invested in proper international dollar-based companies that are at the forefront of leading technology than in South African companies. So I would advocate a much larger portion offshore, and I would really only keep the portion here that I require, for example, to live on comfortably, but to draw money on for my monthly living expenses, and I would rather have most of my money invested offshore. Having said that, you can still find managers like ourselves and others that can give you reasonable returns in South Africa by doing a combination of that, by having some offshore, by shorting companies that are bad, by going long companies that are good. And even in South Africa, the companies we're investing in aren't really South African companies. Naspers is actually Chinese. So you can get some of that exposure here, but I would advocate a very high percentage offshore.
Si, thank you very much. I've thoroughly enjoyed the presentation, and we appreciate that you've given up your time for, to talk to us. Traditionally, we would be giving you a bottle of red wine right now. Non-traditional
I'll drink it here. Yeah. I've got for you. You can give me a bottle of sanitizer instead.
Well, 70% alcohol, so you probably a bit more. But no, thank you, Si. We look forward to meeting you face to face soon in a post-COVID world. But we appreciate the time and the insights, and good luck with generating the returns going forward.
Thank you. Thank you for your time, and anyone who listened in. Thank you.
Thank you, ladies and gentlemen. So what I'd like to do now is go straight into the issue of, is government coming for your pension fund? We've had a number of queries, a number of you that are on the line have called, have sent emails. And I think there's also a lot of kind of misinformation in the media in terms of the issue of, is government coming for my pension? And this was an article that came out in early January on the Daily Maverick. And the reason for that was because the ANC election manifesto had been released. And one of the items in the manifesto was this. In fact, it was one sentence where the ANC said that we should investigate using pension fund money to support economic growth. A year and a half later, we see that potentially the proposals to any changes to Regulation 28, the ANC said they would have that ready by mid-September. Mid-September has come and gone. We're approaching mid-October and there's still nothing. And what was interesting about this one is that they said it will not include prescription. And prescription is the thing that people are worried about. So what I'd like to do is really just talk a bit about this issue of prescription, about Regulation 28, and then just give a very practical kind of insight into some of the other issues around using pension money to help support and grow an economy. So what are prescribed assets? I think prescribed assets, it's not a separate asset class. It's asset classes. It's assets such as government or state-owned enterprise bonds that a retirement fund or financial institution is forced to buy. So with prescribed assets, as the name suggests, there's an element of prescription, that you've got to be forced to buy something. Prescribed assets is not new. The idea of prescribed assets is certainly not new. The ANC didn't come up with this idea. It is something that was legislated in 1958 via the Prescribed Assets Act, where back then retirement funds had to own 53% of government bonds, while insurers had to invest a third of their liabilities into government bonds. So that was some serious levels of prescription back in the late 50s and into, as well, up until 1988, when that Prescribed Assets Act was repealed following recommendations by the Jacobs Committee. Now, what the committee found was that prescribed assets distorted markets. So you were not able to get a fair price or an accurate price for assets in the market if your bond yield is manipulated through prescription, because firms are forced to own your bonds, then your risk-free rate is essentially optically low, and therefore your equity market is then distorted because you don't have a risk-free rate to price the equity market off. So, and it was also found that because of the lower returns, if government knows that somebody has to buy their bond, government doesn't have to offer a high interest rate on the bond. So your returns are lower, and as a result, it was effectively a tax on savers. People were retiring with a lot less than perhaps they would have if there wasn't prescription. We have seen versions of prescription in other countries. So in countries like Malaysia, Singapore, and Sweden, we've seen various forms of prescription. I think arguably people would say, well, those governments have used those funds to the benefit of the populations, and they've got things to show for that money. It's certainly an argument that we cannot argue against, given our government's track record. But if there is to be prescription for retirement funds in South Africa, they would be implemented via Regulation 28 of the Pension Funds Act. That would be the mechanism which the government would use to introduce prescription. So I want to talk about Regulation 28 very quickly. So what is Regulation 28? The broad policy objectives, why do we have Regulation 28? What are the objectives? The objectives of Regulation 28 is member protection. So ironically, the thing that we're worried about is the thing that's there to protect us. Regulation 28 is, one of its objectives is to leverage the link between retirement savings and economic growth as influenced by the level of savings in the economy. So the link between retirement savings and economic growth is there. It's been there for a long time. Your pension can't grow in isolation of the economy. If the economy is doing weak, it's likely that your pensions will not be doing well either. So there is a connection between economic growth and retirement savings. And it's also to reduce the fiscal pressure on the state to provide for citizens through social security programs. So government incentivizes you and I to save for our retirement so that we do not become dependent on government in retirement. So that's why we get the tax breaks that we get. And so what Regulation 28 does is it tries to reduce the likelihood that people lose their pension savings through speculation with their savings. And this is where you see some of the limits. So there's effectively already an element of prescription with retirement funds. Retirement funds are not able to invest more than 30% in offshore assets. not more than 75% in equity, not more than 25% in property, and a maximum of 10% in alternative assets. Hedge funds, private equity funds, those are considered alternative assets. Okay. So how does Regulation 28 get changed? So people are saying government's coming for my money, they're going to use my money to fund state-owned enterprises, or they're going to force my pension fund manager to buy state-owned enterprise bonds and things like that. How does Regulation 28 get changed? I think the important thing to note is that Regulation 28 is an administrative law, and it requires a Treasury, National Treasury, first release draft proposed changes for industry and public comment. What that means is before any changes can be implemented, excuse me, you as an individual, us as GM Investments being industry participants, would have a chance to comment on those changes. And what it means is that we would actually be able to see what changes are being proposed and what changes are likely to come. So we would see that before that's implemented. Treasury may release a second draft for industry, public and comment, and then final proposals are gazetted before being passed into law. The last time Regulation 28 was changed was in 2011. There have been kind of small changes subsequently. I think 2016 we saw an increase in your offshore allocation from 25% to 30%. But before that, the kind of bigger changes that we saw came in 2011. And this is a document which I've picked up off the National Treasury website. And you can see here that it's a fairly transparent process. So not only do they release the comments that were received, but you can also see who actually commented on the second draft of that process. So you can see it was organizations, APSIP, Financial Planning Institute, CISA. It was individuals like George and Leonard and Malcolm and Sagri, who in their personal capacities wrote to Treasury and made commentary on those changes. And then it was a lot of your industry players, a lot of the asset managers, Investec, Coronation, Fed Group, Bright. So the comments that come into Treasury comes from a fairly, well, it's open pretty much to everybody. And what we see is that when they get these comments, what the initial proposed wording was, based on some of the comments and the feedback, they actually make the changes, and you can see in the document the changes that were made and the comments that they received that resulted in those changes being made. And in some cases, you also see that comments are given kind of general comments, not directly related to proposed changes. Those comments are in fact also noted. So I think it's important that people understand that the process itself is incredibly transparent and it's incredibly thorough, and that everybody will get a chance and everybody has a right to comment, and in fact Treasury will note that. The other thing to highlight here is the fact that with that last change, the first draft was released in February 2010, and after deliberation on those comments, a second draft was released in December 2010, and feedback was given, and this document was released on the 4th of March, and the Act came into effect on the 1st of April. So if there are changes coming, you can see that there's in fact quite a bit of time available that you can adjust course before those changes are implemented. So in the last instance, there was a whole year and 2 months that passed before the changes were enacted. So we will have time to adjust course if we see proposed changes that potentially unsettle us. I think this issue that people are worried about ultimately comes down to member protection, and important to remind people that in fact regulation, the primary objective of Regulation 28 is to protect members. But there are also other role players, the trustees. I know we have 1 or 2 trustees who are on this call. They have a fiduciary responsibility to the members to ensure that any investments, any decisions regarding the fund and where monies are invested, that those are sound decisions and the risk associated with those decisions are well understood. There are trustees sitting in jail today because they neglected their fiduciary responsibility. And I think if I look at the current kind of scandal that's out there with some pension funds having invested with Shepherd Bushiri, perhaps we'll see more trustees sitting in jail this time next year. So there are very serious consequences for trustees not taking their jobs seriously. Compliance officers are their role. If you've ever dealt with a compliance person, you know what you're dealing with. That very difficult to navigate around, and have to be picky in terms of asking the difficult questions. And then you also have asset managers who also have a responsibility with their decision making, and who also can put pressure on on entities. So last year we saw, you may recall, Future Growth caused quite a stir in the market when they said they would no longer buy Transnet and Eskom bonds because they were worried about the way those organizations were being managed. And they caused quite a stir, and government responded quite strongly to that comment because, Future Growth is a big buyer of bonds in the market. So government understands that, if asset managers are saying we're not going to buy your bonds, well, then the cost of borrowing becomes significantly higher than if these managers are supporting you. So there's various levels of protection. What I'd like to end off with is just an example of one way in which pension funds and retirement funds supporting economic growth can actually work. My last job at Old Mutual, I sat next to the team that manages a fund called the Ideas Fund. And given my proximity to the team, I obviously overheard a lot of conversations, a lot of telephone calls, and I was intrigued by what they did. And this fund is one of South Africa's largest domestic infrastructure equity funds. And it invests in economic infrastructure like roads and railway, social infrastructure, renewable energy. And while infrastructure investments are vital for economic growth and have tangible social and environmental impact, the fund targets investments with potential to deliver long-term returns and seeks to meet both social and environmental objectives. So, this is the sort of thing that government could put compulsion around, where they say you must invest a minimum of 2 or 3% in a fund like this, not necessarily this one. But this fund was founded in 1999. So it's a fund that's been around for 21 years. It's nothing new. This issue of using pension funds to support infrastructure, investment and growth. These are some of the investments that are in the fund still today. So you can see quite a lot of investment in renewable energy and roads and rail projects. So if you drive to Durban from Johannesburg, 28% of that toll road is owned by this particular fund. I think the Bakwena toll, that's the one going to Rustenburg and to the northwest. And there's track, that's the toll road from Johannesburg to Maputo, the N4. So when those roads were being built, those tolls were being built, this fund invested significant cash into those projects to get them up and running. And now they get a fairly decent portion of those returns being generated by those toll roads. And some of the returns that are going to come from renewable energy. There's also a few cross-border projects as well. The pipeline from South Africa to Mozambique, the gas pipeline, is 12% owned by this particular fund. And what we've seen is that, in fact, it's been a pretty solid performer. So the fund over the last year delivered just over 8%, where the average balance fund delivered 0.5%. Over 5 years, the fund delivered 13, while the average balance fund delivered about 3.8. And since inception, the fund's delivered about just over 15%, whereas the average balance fund delivered about 11.5%. And pretty much your balance funds make up the bulk of the assets in your retirement funds. So the point I'm making there is that if executed properly, supporting infrastructure can actually enhance a pension fund in terms of the returns it can bring to that fund. There are a whole lot of other issues that go around with this. Obviously, it's a very illiquid fund, so you can't have too much invested in a fund like that, and there tend to be fairly long kind of lead times associated with investing in projects like that. So in conclusion, we do not know if government will reintroduce prescription. As things stand, we have no idea. What we do know is that that the process allows us enough time to adjust course if we need to adjust course. So if the first draft proposals that come out says that there needs to be a minimum of 20% invested in government bonds or SOE bonds, something like that, we have a year in which to adjust course. National Treasury has not yet been approached to discuss proposed changes to Regulation 28. So Treasury has come out and said, nobody has asked us to start this process. So they're reading what we're reading in the media, and they are not seeing where a lot of that is coming from. And then infrastructure investments, if done right, can actually enhance returns. The Old Mutual Fund is one fund, and our RMB have a pretty big fund that's performed well. And there are other infrastructure funds out there. So depending on what the changes look like and how that support needs to come from pension funds, it's not automatically a bad thing. And I think important to note that knee-jerk reactions based on speculation are certainly not necessary. People are being told not to invest in retirement annuities. People are being told to leave the GEPF. People are being told to cash in their pensions and their preservation funds and to disinvest and take the money offshore. So they're incurring big tax liabilities. They're selling the currency when it's cheap, and they're buying into offshore markets that are potentially a lot more expensive than local markets. and destroying a lot of value along the way. So we think there may be a time to react, there may be a time to act. That time is not yet arrived. If we are making any decisions, it would be on speculation and hearsay. So that's our take on the issue of whether or not government is coming for your pension. There may be, but the process to do so hasn't started. If that process starts, we'll certainly know about it before it happens. I'm going to open the floor for questions. I see there are one or two questions that are coming through. Okay, I've got a question here from Rachel. Rachel says, in the event that government, okay, some of these other, okay, in the event the government decides to utilize pension funds to fund state assets, will it be applied universally, including funds of those currently on pension? That's a good question, Rachel. We need to see what the proposal from government would be. So we can't say for sure that, whether you're already on retirement, you'll also be forced to invest. Remember, if you're already on retirement, you can invest in a living annuity, and a living annuity itself can invest 100% offshore. So on that basis, you would be able to avoid any changes that come to Regulation 28 as someone who's already retired. But as it stands, it's very difficult to speculate what any changes could look like.
Craig, if I may comment on that as well, we must remember that if the prescription is going to happen, as Craig has suggested, it's probably going to happen through Regulation 28, which is a regulation of the Pension Funds Act. And most people who are sitting in living annuities, the living annuity is not regulated by Regulation 28 in itself. So it probably won't be forced. However, most people, even in living annuities, invest in balance funds, and those balance funds are regulated by Regulation 28. So if you're already in pension, you probably might not have a direct impact, but it may be more an indirect one depending on where you choose to invest your post-retirement money.
Yeah, and we would watch that. So, the last time Regulation 28 was changed, if you were non-compliant before the change, you could remain non-compliant after the change, provided you didn't make any amendments to your retirement savings. So if that is also on the table, then we can make changes before they change Regulation 28, and potentially you could avoid, the fallout from some of those changes, whatever those changes might be. Yeah. There aren't any other questions. Okay, this is a comment that my voice gets lost from time to time. My apologies for that.
Even we learn, it's the new technologies.
Indeed. Ladies and gentlemen, it's 10 past 5. As I noted, in the new world, when we get to the end of the time allocated for that particular webinar or online meeting, people generally leave on time. So COVID has definitely helped us to keep to time a lot more efficiently. So we see a lot of people have in fact left. So I think at this point I will, from my side, say thank you very much for those of you who have stayed, the diehards that have stayed right till the end. We appreciate your time. We hope that this was a useful session and that you got value for the time that you've allocated to us. Thank you from my side.
And from our side as well, thank you very much for supporting us in another investment conference that we've had this year. If we haven't taken your comments or questions here, please feel free to drop us a line or drop us an email. We'll be happy to take your questions offline. Thank you very much from myself, Craig, and the rest of the team.